Keep calm and carry on buying AI tech stocks as they deviate from the highs. Where the greater the deviation, then the greater the buying opportunity presented. Keep calm and carry on buying. Quantum AI tech stocks.
Today we're going to the Bank of England.
Bailey, the idiot in charge of the Bank of England, now warns of 30% inflation, 5-quarter deep UK recession, and therefore requests the workers of Britain not ask for high pay rises due to the risks of sparking the wage price spiral. Despite paying himself near £600,000 a year for making a dog's dinner of the UK economy. So are his predictions going to come true? Well, a year ago he was barking about transitory inflation and growing economy ahead. Completely clueless, this idiot. They all are just yes men, idiots, academic clowns, clueless. The problem is this: the Bank of England caused the inflation by means of rampant money printing on an epic scale that they used to monetize near.
Now we're inside the Bank of England.
That they used to monetize near half of the UK government debt. That's £1 trillion, and we don't know what's off balance sheet, what they diddled and fiddled. That's what caused all the inflation. And now the morons are trying to fight 10% inflation, heading for 13% with a 1.75% base interest rate. That's like pissing on a forest fire. Bailey and his fellow clowns do not have a clue. They are literally fumbling in the dark for the light switch. And we are paying the price for these idiots. You know, loss of purchasing power of money. Your money's going to lose 13% of its value. You know, over the next year. So what do? You have to get out of sterling. You have to get into assets that cannot be printed. You could go into good US stocks. You could go into housing. There are ways out of this nightmare, inflation nightmare that these clowns have created. And as for the wage price spiral, it does not exist. It is a con. There is no wage price spiral. Instead, it's a price wage spiral. It's wages that are trying to catch up to out of control inflation rather than driving inflation. They've got it the wrong way around. Out of control inflation and failing to do so, and hence the cost of living crisis, where wages are just not keeping up with rising prices in the shops. They're a step behind. Prices rise, then wages try and catch up, and you got this overpaid moron in the Bank of England telling people not to ask for pay rises. What a con. This is what the inflation con is. And I've been warning of this for over 2 years now, ever since hyper QE resumed in March 2020 in response to the Chinese virus, that this would sow the seeds for very high inflation. Now, I was expecting, it's very difficult at 2%, 1.6% to say it's going to get a 10%, but that is what I was expecting, and that's what I repeatedly warned. You know, go back and watch any of my videos the past 2 years, and they always tend to end with a warning that very high inflation is coming, to prepare yourself now for its consequences. You know, it was the writing is on. It was on the wall. They're printing money on an epic scale to monetize government debt. How could that not cause inflation? Unless they fiddled the CPI. They already fiddled it to death. Real inflation is double CPI. UK inflation will not peak at 13%. It'll be 26% on the 1980s measure of inflation. What a con. Let's calm down a bit. Let's take it down a notch. I've been warning about it for over 2 years. No point getting worked up about it. The high inflation I've been warning about is coming to pass now with a vengeance. And I warned to the extent that high inflation will run for the whole of this decade because of the mess they've got us in, these idiots. As this 10-year inflation graph illustrates, acts as a harbinger of what to expect, that few have any inkling of just how bad it's going to actually get. We're at the beginnings, because inflation is going to compound. Even if inflation fell to 4% from 10%, which is not going to do, because even the Bank of England recognised they've messed it up. They created such a dog's dinner, it's heading for 13%. Even if it fell, it would not make any difference, because it's compounding. Look at the 10-year graph. What happened in the 1970s? That's what we're in for. It's going to be a nightmare. And peak inflation is a complete red herring. When one looks at under the CPI inflation hood, like in the United States I'm on about now, then one sees strong signs of inflation topping, given that we have already seen transpire in the commodity market, such as gasoline prices have fallen since the May inflation report, and many other components such as airlines are also turning lower. So it is turning lower under the hood. So obviously this is being taken as good news. You can hear the talking heads, the clueless, saying, oh look, it's sign that inflation is topping out, turning over. So inflation is peaked, so the Fed can take the foot off the brake, and I'm sure will soon be accompanied by murmurs for the possible return of QE. After all, I can imagine many are thinking, yes, inflation is running hot at over 9% in the US, but it's not that bad. So maybe the 1970s were not as bad as people tend to make them out to be. Unfortunately, the annual change in the rate of inflation that virtually all focus on is a red herring and fails to represent the true damage done by inflation during the 1970s, and that the US and most of the West look set to replicate during the 2020s. For the fundamental fact, the peak inflation that everyone is seeking and likely to get as early as next month is irrelevant. It's what happens in the run up to the peaks in the aftermath that does all the damage. This is why virtually all of the pundits and so-called economists fail to understand that the peak inflation they're all focusing on is not the end of inflation, but marks the beginning of the inflation pain that will persist for the whole of this decade. So understand this. All the pain folks experience today is nothing compared to that which is to come, where my 10-year inflation chart gives a clear picture of what happened during the 1970s and what has a high probability of repeating during the 2020s. Those 12-month peaks are largely irrelevant. The US, UK and the rest are going to experience waves of inflation, which whilst they won't exactly replicate the 1970s in terms of magnitude, US inflation is peaking at 9%, 10% rather than say 12 or 14%. But the issue is that everyone assumes that inflation peaking is the end of the inflation story. Nope, far from it, because as you rightly assume, the Fed will take falling inflation as a cue to take the foot off the brake, and thus the economy in the not too distant future will head towards its next inflation peak. And then the central banks will rinse and repeat for the peak following that, which will result in a very similar 10-year cumulative inflation graph as that which occurred during the 1970s. And that is what will deliver a decade-long inflation pain that few are prepared for. They have not experienced it. They have no idea what's going to come. Most will fail to understand that even a 50% drop in the rate of inflation from say 9% to 4.5% is not going to do anything in terms of addressing the relentlessly worsening inflation pain that most are destined to suffer for the whole of this decade. We're only at the beginning of the inflation pain, as the chart illustrates. Barely begun its ascent that is going to wipe out the purchasing power of earnings and savings. As for asset prices, to repeat one of my mantras, seek to be invested in assets that are leveraged to inflation megatrend That's good stocks bought at fair valuation that can raise their prices. So basically one wants core portfolio to carry a low PE ratio, coupled with the potential for earnings growth, where my core AI stocks portfolio, perhaps minus Amazon, carries an average PE of 16.6. I expect earnings growth to continue to drive lower over the coming quarters. And then there is housing that cannot be printed, which is where the bulk of my personal wealth resides. Now it's 45%, with stocks targeting 30%, may go higher because I want to get out of cash. Which will, it still leaves me 25% in cash, so I'm going to have to whittle this down to something like 15%. Hence why I dabbled in cryptos to a limited extent last year, and recently logged into Binance to buy some more, though only with existing funds. So feel free to comment below your suggestions for other asset classes, apart from precious metals, which everyone knows about, to investigate to avoid the inflation stealth theft. As my last resort will be to seek to buy another property, but as you're probably already aware of, property prices are not cheap. And unfortunately I don't see what's going to deliver lower prices given inflation. Bottom line is that peak inflation that the pundits are focusing on is a red herring. Unless there is a miracle whereby magic CPI falls to under 2%. But then again, 2% CPI is really, 3.5%, 4%. So perhaps we need to see CPI averaging 1.5% for the inflation monster and its consequences to be fully contained. Unfortunately, perched there at over 9%. I don't see sub 4%, let alone sub 2% anytime soon. So don't be fooled by the talking heads when they sing the praises of CPI falling to 5% in some months' time, for it will actually have changed nothing. Just go look at the 1970s, where the first trough was at 3% and the second was at 5%. They did nothing to avoid the relentless climb into the inflation mountaintop. Nothing. There's still time to act to protect your wealth, our wealth, my wealth, your wealth, because inflation is going to eat it all, make it worthless. Then there are the risks of the crack up boom, which I've covered in earlier videos, articles anyway. And this video is an excerpt from my recent analysis on the state of the stocks, bear market and more, that was first made available to patrons who support my work. So for immediate first access to all of my analysis and trend forecast, then do consider becoming a patron by supporting my work for just $4 per month. UK housing market analysis. This video is part of a series based on my extensive analysis that concludes in a detailed 3-year trend forecast for UK house prices that was first made available to patrons who support my work. So for immediate first access to all of my analysis and trend forecasts, then do consider becoming a patron by supporting my work for just $4 per month. And my UK housing market analysis will soon be followed by my even more extensive analysis of the US housing market that also concludes in a detailed 3-year trend forecast, which is at a time of maximum price uncertainty, where even the Fed does not know from one meeting to the next what they're doing. Barely days before the Fed hike rates by 0.75%, the chairman Jerome Powell was saying that 0.75% hike was off the table, which illustrates the degree of uncertainty out there. And also access to my most recent ongoing analysis geared towards capitalizing on this stocks bear market that I warned to expect last December. Capitalize on by accumulating AI tech stocks at deep deviations from the highs at target buying levels, which again first being made available to patrons who support my work. So do consider becoming a patron by supporting my work for just $4 per month, gaining access to over 35 years experience, right from before the 1987 crash straight through to this stocks bear market that will ride the quantum AI megatrend into the future.